Good morning, everybody. It is June 15th, and you're watching MarketStream.live. What's hot on the open? We're going to take a look at all the action that's occurred so far in the U.S. Open, and it has been fast and furious. The Fed came out very hawkish yesterday, raised rates quarter a point. So if you have a credit card balance, any short-term loans, anything of that nature, you're paying more now. And the expectation is they're going to continue those rate increases through 2018. What they also did was they said they're going to get more aggressive on balance sheet reduction. In other words, all of those bonds that they kept buying, and then when they roll off, they'll buy more, as well as mortgage-backed securities. Well, they're going to stop that process. They're no longer going to be buying them. They got to unload this, and they're going to unwind that, going and could be as aggressive as starting this year, that portfolio. And so that's going to impact the markets. And they're going to watch, though, before they start pulling any of those levers, how the economy is chugging along. They're going to watch the PPIs, the CPIs, growth, GDP. They're going to continue to watch wage inflation or lack thereof. But the point being is that they're going to be aggressive going forward. And there was very little, if any, dissension there. The markets this morning, though, opened up a little bit lower. You're seeing some profit taking post the Fed. And let's take a look. Taking a look at the Dow Jones. And before I get started, though, I want to take a look at why I cover this stuff I do in the mornings and the afternoons and strategically. Because, here you're seeing the model portfolios that I would work with a client. And you can just scroll down. Let's just say, for example, I'm looking for someone. I sat down. They have retirement 11 years from now. So I just click on this. And basically why I talk about Asia, Europe, the United States, and so forth is because we start to put these portfolios together for you so that you can actually go in and build, get a perspective based on your objectives, your risk tolerances. This one has a risk factor of 61. What does that mean? Well, on a scale of 1 to 100, this is basically mid-range. We've realized based on the criteria that they put in as far as their risk tolerance, their objectives, the money that they have to work, that this fits their comfort level. This is their risk number. This gives you a 6-month risk and reward factor with a 95% probability, and then you see the potential returns, you see the annual dividend, and the expense ratios. And as you will draw down, you will start to see that as we go through these different examples of portfolios, you're going to see the FXI, that's Asia. Specifically, that's China. This is a commodity ETF. This is an all-world ETF. This is a REIT ETF. This is the Qs, which is the NASDAQ. This is another all-world with more weighting in Europe, and the S&P 500 and so forth. You can get a feel then of how you put these different ETFs together, whether or not they're aggressive or conservative based on the risk number. The higher the number, the more aggressive. You're looking at with a 95% probability, in other words, 2 standard deviations for you stats geeks out there, 17% downside potential or 27% upside. And then you can get some worst case, best case scenario with some stress tests. What does it look like if we had the bull market of 2013? What does it look like if we have the bear market? And what does it look like if we had another financial crisis and interest rates go through the roof? What would happen with interest rates, or interest rates start to crumble? Point being is that you're going to get a full transparent view then, and then that's why we talk options, because options can mitigate that downside risk or that capital risk. Now, for that risk factor being mitigated or reduced, that means that you're going to give up some upside, but last time I checked, there is nobody that has been able to guarantee unlimited or unlimited upside profit potential. Let's also start getting some reality here. Let's understand where the markets are today after the Fed, since they're down across the board. The Dow Jones is down 41 points. You can see that right here at 21,332. No need to panic. It's bouncing off of its lows. It's still in a very strong consolidation, and it's above its 20 and 30-day moving average. Now, where do you start looking at it from a short-term perspective and saying, well, I need to watch this? 21,130. That's where you're going to watch the Dow. The S&P 500 down 11 points today. This one is challenging its 20-day moving average, folks. Right here you saw a big pullback yesterday. It firmed up towards the close, but it opened up lower today and is now challenging its 20-day. On the SPX, watch 2,420. That's going to be a level. That's only 6 points away right now. You can see it's at 2,425. That's a level that you're going to want to watch if you're a short term. Also, one thing that's notable I want to mention to everybody. If you have positions in the spiders, the Qs, XLP, XRT, KRE, call your brokerage firm. They should know this. They're all going ex-dividend today. And that's a big deal, especially those of you that have spider positions, SPY. These ETFs are all going ex-dividend, and the spiders are going to pay about $1 dividend. So in other words, if you're an options trader and you have an in-the-money option, now this is expiration, so if you have an option that has a strike price of basically 242 or lower, you're at risk of being assigned early. And then that means that not only are you going to be short stock, you're going to be delivering $1 dividend as well. So add insult to injury. So manage that risk today. Taking a look at the NASDAQ continues to struggle. It is in that battle zone, folks, and it's pulling back today. It's now on its 50-day moving average. So short-term bulls, they're already been knocked on their butts. Now you have intermediate-term bulls. They're under some pressure right now. A break on the NASDAQ 100 specifically, which has a higher, it's 100 of the highest capitalized stocks in the NASDAQ. So the FANGs are really going to, if they start to move, and Apple's been weak, one of the more notable ones, 56.44. We're at 56.55 on the NASDAQ 100. A break of 56.44 means that the bulls in the tech sector are really in trouble, and that could signal some deeper concerns. The Russell 2000, these are the domestically centric small cap stocks. They challenged early the 20-day moving average, but they bounced off. You've seen that they've come off of their worst levels. Watch this one closely. We're going to watch 1400 on the rut, and then we're going to watch 1390, 1389. Those are the two levels that the bulls are going to need to hold on the short term and the intermediate term in the small caps. Now I'm giving you these levels just so that you don't have to go into panic mode, that you understand that yes, there's a pullback, but maybe there's some opportunity, and that's why you're going to stay tuned today for Strategy Now. We'll go over some of those opportunities. What has been knocked down its butt has been crude oil. Crude oil has just been plummeting for the last 2 sessions. And today is down just another 7 cents, but it's below that $45 level. I had mentioned it on Monday. I was on Bloomberg, and I've been talking about this for weeks. I still think this $44, $45 level is an area that has to hold. Otherwise, you're going to see a deeper drop. Now, stocks, as far as storage is concerned, the amount of crude oil that's in storage is still at a 5-year high. And even though we had a small draw, it was much smaller than anticipated on the crude oil side, but we had a larger than expected increase in gasoline stocks. In other words, what we put into our cars, well, 2.2 million barrel increase in gasoline stocks. That means that we should start seeing maybe a little bit of pressure off at the pump, but we'll see. We're also seeing that the Brent contract, this is the contract that is primarily traded in the Middle East and over in Europe. This is what they use for like diesel fuel and so forth. This is pulled off precipitously. OPEC nations are all over the map. Now, they said that they're going to adhere through 2018, into 2018, the production cuts, but they haven't gone beyond saying that they're going to keep those production cuts at 1.8 million barrels a day. They need to increase that. There's a glut. Now, the Saudis are out putting a ton of rhetoric out there. It hasn't worked. It continues to go down. There's other headlines with Qatar and so forth. There's also concerns about global growth, as well as the geopolitical concerns. Gold is getting knocked on its butt today, and as a matter of fact, it's below its 50-day moving average. This is where the bears have started to take control here. This is an area that I'm going to start focusing on with my clients, just as an FYI. Want to see what the opportunities are in this precious metal, but that is something where a safety trade has come off post the Fed, post the UK results. as far as their elections and so on and so forth. So we're starting to see that gold is losing a little bit of its luster. Let's see if the bears are actually getting into control there. We are seeing a slight bounce in copper. Copper is trading in negative fashion. We're going to watch this one closely. This infrastructure metal, this is the one that I look at and basically say if there's going to be growth on that component and that side, whether it's housing, whether it's infrastructure, this needs to move. There's a lot of pressure. With rates going up, that's going to put a pressure on home builders. That's going to put pressure on anything interest rate bearing, which then could put pressure on this commodity, copper, especially if there isn't that growth factor that kicks in. Bonds, the short end of the curve, popping. The long end of the curve, after what was an impressive move on the 10-year and the 30-year as far as price action, they're pulling off today. A little bit of profit taking post the Fed. The fact of the matter is that the short end of the curve got beat up a little bit yesterday, but really has bounced overall. We're going to watch this one very closely. The Federal Reserve is going to be raising rates. They still have one more rate increase that's looking like it's going to be more towards December, not during the summer or even early fall. It's about a 48% probability in December. Otherwise, everything's south of 20% for a rate increase going into either the July, September, or October. We're looking more towards the end of the year. Watch the 10-year yield. I always watch that as a barometer. Last time I checked was at 2.17%. Let's take a look. And it is still at 2.17%. This is still very low. Yes, there's a pullback in price and a bounce in yields, but it's still well below anything that I would consider a viable yield bull move. But what is concerning is the fact of the matter is the short end of the curve could be moving a lot quicker to the upside than the long end of the curve, and we're going to watch that. Now today that's not happening. Short end of the curve is moving up in price. That means yields are coming down, so that where the 2-year is actually getting closer to the 10-year, then the 10-year getting further away from the 2-year. Let's watch that very closely. That's going to be a pretty decent barometer of what's going on economically here in the States. All right, folks, we covered a lot of stuff this morning on what's hot in the open. I'm going to be back at 1:30 Eastern Time, 12:30 Central. We're going to be talking some strategies that you can implement for your portfolio, especially in this environment here at MarketStream. See you then.